วัสดีค่ะนักลงทุนและนักวิเคราะห์ทุกท่านขอต้อนรับเข้าสู่ Set Opportunity Day ประจำไตรมาส 2 ปี 2566 ของบริษัท PSL Shipping หรือ PSL ค่ะวันนี้ดิฉันศิรศาสตร์สุภาวศิลป์จะเป็นผู้นำท่านเข้าสู่การรายงานของบริษัทในวันนี้นะคะเช่นเดิมค่ะการรายงานของเราแบ่งเป็น3ส่วนแรกจะเป็นการรายงานภาพรวมอุตสาหกรรมโดยคุณคาริท ฮาชิมCEO และส่วนที่2จะเป็นการรายงานตัวเลขผลประกอบการต่างๆโดยคุณกอทัมคูรณาค่ะและส่วนสุดท้ายนะคะจะเป็นช่วง Q&A ค่ะหากท่านมีข้อสงสัยหรือว่ามีคำถามใดๆก็สามารถส่งมาในระบบได้ค่ะเพื่อไม่ให้เป็นการเสียเวลาขอเชิญคุณคาริทค่ะ
Thank you, Sirasa. And Sawadee Krap, everybody. Before we start this presentation, I want to just point out something which is on the screen in front of you on the lower left-hand side. It shows you that we were awarded a carbon neutral certification for the year 2022 by the government-owned Thailand Greenhouse Gas Management Organization. Coming to the freight markets, if you look at China's performance in the first half of 2023, it was quite amazing. Iron ore was up by 7.6% in the first half of the year, as against down year over year at minus 1.6% last year. Coal imports were up a staggering 93.2% to 221.9 million metric tons. Against that, we had a 9.4% fall last year. Steel production was up by 1.3% at 535.6 million metric tons versus a minus 1.8% last year. Steel inventory was 14 million metric tons, down by 11.5% as against down by 10.1% in 2022 versus 2021. Steel exports was up 43.9 million tons up by 31.1% versus a 0.9% increase last year. Steel consumption was up by 1.1% to 495.4 million metric tons in the first half of this year versus minus 2.3% last year. So whichever metric you look at, China has done really well. Now, if you look at the month of June, it was extraordinary. Coal imports were up in June at 39.9 million metric tons, up 110% year over year. And year-to-date imports were up 93% at 221.9 million metric tons. First half, coal imports almost doubled over last year and was 38% above the 5-year average. Iron ore imports dropped by 1% month over month to 95.5 million metric tons in June, but remain up 7.4% year over year. Year-to-date, iron ore imports at 576.5 million metric tons is up 7.6% year over year. It's the highest ever recorded and 6% above the 5-year average. Soybean imports came in at 10.3 million metric tons in June, up 25% from the year prior. Year-to-date volumes at 52.6 million metric tons is up 14% year over year. And soybean imports are now 14% above the 5-year average and is the highest ever recorded in China. So you can see clearly that despite all the Western media news about China, as far as dry bulk is concerned, China has done really, really well. If you look at China's housing market, and again, an area where the Western media keep trying to play up the problems that are there. And if you examine the issues, what would you see? You would see that the market has experienced a 30% drop in home sales in 2022. You would also see that the downturn has raised concerns about the future oversupply. If you then look at new home sales between the years 1999 and 2022, you would see that households have gone from 202 versus 229 million. From the 2020 census, 35% of households live in homes built before 1999. Now, this data is important because those were old houses, and modern housing is described as those houses built post 1999. So if you analyze it like that, you would see that urban households in 1999 measured 122 million. The urban household increase during 1999 to 2022 was 229 million. And residential units sold in the period 1999 to 2022 was 202 million. So the difference between these numbers amounts to 149 million households which are not served by modern housing. If you then look at these two other major arguments, one is on demographics. The Western media plays up the fact that there's a declining population in China, but what they don't state is that the declining population is mainly in the rural regions. In 2010 to 2020, the urban population in China actually increased in all age groups except the 20 to 29 age group. And there it declined at a much lower rate than the national average. New home sales market primarily caters to urban population, especially those seeking modern housing. So this is one area that you need to focus on. The second area you need to focus on is what is the realistic construction supply. Now, statistics, especially in the Western media, show that gross floor area of about 7 billion square meters is under construction. And of course, this gives you the feeling that there is massive overbuilding. However, half this figure, or 3.5 billion square meters or more, consists of projects that have been stalled for over 5 years and should not be considered as part of the future supply. So these factors put together, and the Chinese government's goal to increase urbanization rate from 65% in 2022 to 75% by 2035 suggests a more optimistic outlook for the property sector in the near to medium term. Coming to dry bulk trade forecast in billion ton miles, and this is what we are looking at is based on Clarkson's numbers. So if you look at the row from the second, the row third from the bottom, you will see that in 2023 they are forecasting an increase in trade of 3.27% in 2023, and in 2024 they are forecasting a 2.54% increase in trade. If you then look at the last row and look at the change in the net fleet position, which Clarksons are forecasting for 2023 at 3.6%. And if you look at 2024, they're forecasting a 1.8% increase in net supply of ships. If you then drill down just to the minor bulks and look at the same rows and columns, you would see that minor bulks are set to grow by 2.39% in 2023 and by 3.68% in 2024. Against that, net supply in the smaller size ships or the geared ships would grow by 3.7% in 2023 and 2.5% in 2024. Now, Clarksons have been changing all these numbers ever since the start of this year. So for example, if you look at the left-hand side, top part of the slide, you see that in the Jan 23 edition, they were forecasting an overall growth of 1.59% for demand and minor bulk demand to grow at 0.47%. Then in the March edition, they increased the overall growth to 1.92% and the minor bulk growth dramatically shot up to 1.28%. And then in the June edition, you can see that both overall growth went up to 3.27% and minor bulk growth went up to 2.39%. And this is based mainly on the actual results on the ground in the first half of this year, with China's imports being imported quantities being at a record high. Now, if you look at the right-hand side, the top portion of the slide, it shows you the 2024 figures. I will not go through that. You can see it on the slide yourself. If you look at the lower left-hand side, you can see how the supply side has been forecast by Clarksons at different stages. Overall growth of dry bulk ships would be 2.4% in the January edition, with the smaller size ships being at 1.3%. Then in March, they raised that to 2.7% for the overall fleet and 1.9% for the dry bulk fleet. And then if you come to the June edition, they're both almost even at 3.6%. Similarly, on the right-hand side in the lower portion, you can see what's going to happen in 2024. Now, the reason for showing you this slide is that Clarksons, with all their research capabilities, are not able to get simple numbers like demand and supply accurately forecast. And it keeps changing based on what's going on in the market. So please keep this in mind when you're looking at tables from other brokers or any other sources that these things keep changing as things on the ground change. This slide shows you the amount of time each category of ships spends in carrying each type of cargo. So for Capesizes, they're predominantly carrying iron ore at 74%, coal at 19%, and one minor bulk, which is bauxite from West Africa, where the mines are owned by China, and the ships and everything, loading facility, ports, etc., all owned by China, and they transport 7% of bauxite worldwide. If you come to Panamaxes, you can see 8% on iron ore, 52% on coal, 25% on grain, and 15% on minor bulks. But when you look at Supras and Handys, what do you see? You see that they carry 54% of minor bulk for Supras and 66% for minor bulks in Handysizes. So you can see quite clearly we are much more dependent on minor bulk than we are dependent on major bulks, which are the first three cargoes, iron ore, coal, and grain. But having said that, if you look at Supras, coal is 26%, grain is 15%. If you look at Handys, coal is 10% and grains are 19%. So we do carry some part of major bulk, but the majority of our time is spent on minor bulk cargoes. This slide shows you how the overall net position of ships has changed in the first half of this year. So if you look at the right-hand side, lowermost column, you can see that Handysizes grew by 1.54 million deadweight tons. Supras, Ultras grew by 3.91 million metric tons. So overall, the geared ship sector grew by approximately 5.5%. By 5.5 million deadweight tons. If you look at Panamaxes and Capesizes, they grew by almost 11.25 million deadweight tons. So they're growing at a much faster pace than us on an absolute deadweight ton basis. If you look at the forward order book, it is totaling at 72.38 million deadweight tons, or 7.36% of the entire fleet. On the geared sector, it's at 30.67 million deadweight tons, or 8.86% of the existing fleet, whilst for the gearless sector, it is at 41.71 million deadweight tons, and that's 6.55% of the fleet. If you look at it on a historical basis, the year when it was the highest ever, the forward order book was at 78.14%, which was at the start of 2009. And if you look at the right-hand side of the slide and you see how the percent of 20-year-old ships has finally gone above the forward order book, this is the first time you could see this happening in this century. And that means that supply side will be fairly limited going forward. If you look at this slide, we've tried to show you how things have changed between the 2003 and 2009 bull run, the 2010 to 2020 disaster area, and then in 2021, 2022, and the first half of 2023, we're showing you what's actually happened. So if you look at the fifth row from the top, you can see that demand during 2003 and 2009 grew by 5.4% every single year. In the 2010 to 2020 period, it dropped from 5.4% to 4.2% per year. And in 2021, it grew by 3.68%. In 2022, it was minus 1.45%. And in 2023, it's supposed to grow by 3.27%. The next row after that shows you the average speeds of ships during that period of time. So here you can see that in 2003 to 2009, average speed was 13.5 knots per ship per day, per hour. And in 2010 to 2020, it was 11.5 knots. In the 2021 year, it was 11.4. And 2022 dropped to 11.2. And now in the first half of 2023, it's dropped to 11 knots. If you then look at the last row, you can see the average net increase in the fleet per year in the first period of time was 6.8%. In the bad area was 6.4%. 2021 was down to 3.55%. 2022 was down to 2.86%. And Clarksons are forecasting for 2023, 3.6%. The most important part is that at the start of July 2023, the 20-year-old fleet was at 8.24% versus the forward order book at 7.36%. So again, it shows you that the forward order book is not able to replace all the older ships which are there in the fleet. This slide shows you the average speed between the years 2012, 2020 in the first bar, in the year 2021 in the second bar, and in the third bar in 2022, and the fourth bar shows you the average speed for the first half of 2023. And in all cases, you can see the speed has been dropping quite consistently. In terms of congestion, if you look at this slide, it shows you that the first half of 2023, the congestion was at 31.6%. And if you then compare that with the 5-year average and the 7-year average, the 5-year average stood at 29.9%, and the 7-year average stood at 30.7%. So you can see that the average for congestion for the first half of 2023 is not significantly different than in the past. If you examine this slide, we are trying to show you what happened to the BDI in the first half of this year compared to last year, the year before that, and the year of 2020. So if you see that, then BDI dropped by 49% compared to 2022, dropped further by 49% compared to 2021, and was up by 69% compared to 2020. Keep in mind, 2020 is a low base year for the first half because it was hit by COVID-19 at that time. If you then look at the orders placed in the first half of 2023, it was at 14.42 million deadweight tons, and compare that with the first half of 2022, it was down by 18%. Compared with first half of 2021, it was down by 49%, and compared to the low base effect of first half of 2020, it was up by 23%. Now, there are reasons why new ships have not been ordered in a bigger way than they have. And the reasons are as follows. Firstly, is that LNG, container ships, car carriers, gas and tanker ships have booked all available slots at shipyards, and hence dry bulk has been crowded out. Now, at best and earliest, you can get ships in 2026. If you look at the second point, shipyard capacity is still 40% below the peak. In the peak, 119 active large yards were there in 2022. And they are now down to 3 in 2022, and it was up at 320 shipyards in 2009. Now, despite dry bulk owners having enough money to invest in new ships, the death of the internal combustion fuel oil burning ships and the fear that these assets might become stranded is what is constraining the order book. So the key industry takeaways are as follows. IMF is estimated global growth, GDP growth of 3.3% in both 2023 and 2024. Both, at least the 2023 rate was revised upwards. Chinese GDP will grow by 5.2% in 2023. It's unchanged from their previous forecast. The actual growth rate in the first half was 5.5%, yet American banks have downgraded China's growth rate to about 5.1%. In the first half, in the early part of this year, the same American banks were forecasting a growth rate for China of between 6 and 6.5%. Demand growth of 3.27% in 2023 will be largely driven by China's economic recovery. China's fixed asset investments in the first half of this year is already up by 3.8% compared to last year, and consumer spending has rebounded above inflation rates. In terms of iron ore imports at 576.5 million metric tons, up by 7.6%, and Brazil exported 106.6 million metric tons to China, was up by 18.5% compared to last year's first half, and Australia exported 370.2 million metric tons to China, up 64.2%. And both these movements assisted the Cape-size ships to have stronger rates in first half. The forward order book to fleet ratio at 7.36% as of the 1st of July is lower than the existing 20-year-old fleet at 8.24%. So supply of new ships in the future will be constrained and restricted. The dry bulk fleet is forecast to grow by 3.6% in 2023 and by 1.8% in 2024. But keep in mind, net supply will be reduced according to Clarksons by between 2 and 2.5% during 2023 and 2024 due to lower speeds by the new regulations of EEXI and CII. This should help supply-demand balance improve in 2024. So what is our strategy keeping all these industry takeaways in mind? We've kept our fleet size at the same 38 ships. The average age is 11.5 years. We're younger than the world average age for our size and type of ships. Insured values are about $765 million. Book value is $624 million. Total deadweight is 1.7 million deadweight tons, and each ship is about 44,000 tons. In terms of our performance versus the index ships, the handy-size ships performed at 0.49% or 0.5% above the index ships, and the Supras and Ultras performed at 17.14% above the index ships. Keep in mind that our handy-size index ships are about 20%, 25% smaller than the average size of the index ship at 38,000. And in the Supras, and therefore should be at a discount of about 25%. Whilst in the Supras, due to the fuel consumption and the size of our ships, we should be at a 10% discount to the index ships. In terms of a forward cover, if you look at 2023, we've got a total of 6,940 days booked at $12,251 per day per ship, and that would give you $85 million of cash flow booked under the longer term contracts. If you look at 2024, that drops to 2,212 because we are predominantly trying to do a short 1 year type of contracts on all our ships, so that once the market starts to rise, we can take advantage of it. These 2,212 days have been fixed at 13,533, and the total forward booking for the year 2024 is at $30 million. If you look at 2025, it drops to 1,825 and stays steady thereafter, because these are the 5 ships that we have on long-term charter with one of our clients. And you can see that that gives us about $27 million each of those 2 years. In terms of PSL and ESG, what do we have? First of all, as I've already told you, carbon neutral certification for 2022 by the TGO. Now, TGO also gave us something known as the carbon footprint for organization in acknowledgement of our comprehensive carbon reporting practices. We've also reduced our environmental impact by the use of eco ships, and our average grams of CO2 per ton mile of cargo carried has reduced from almost 13 in 2014 to down to 7.14 in 2022. We've also used many FSDs or fuel saving devices, which has allowed us to save somewhere between 3 and 5% of greenhouse gas and fuel oil being burnt. We are, of course, certified for ISO 14001 and 2 by the 2015 standards, and we are founder members of the Getting to Zero Coalition, which consists of more than 160 companies and about 10 governments involved in this organization. That's on the environmental front. On the social front, we continue to support the Michai Patana School. We've done it from 2022, and we're going to continue to do that in the future also. We are also providing scholarships for 42 students since 1995 each year for the Merchant Marine Training Center. And we've also awarded 21 school and college student scholarships to children of our staff at the office. In terms of governance, PSL is the highest ranked global dry bulk shipping company in the S&P Corporate Sustainability Assessment Rankings for 2021. And in the top 12 percentile of global listed transportation companies, which means including airlines, road transport, rail transport, and shipping. We are, of course, included in the Stock Exchange of Thailand's Sustainability Investment Index for 2022. And we also have received the Outstanding Investor Relations Award for 2 consecutive years from the SET. We've also had the 2021 distinction of being the ASEAN Asset Class Award for a corporate governance score of 97.5%. And we've also been classified as an excellent corporate governance for 13 consecutive years from 2010 to 2020. I think it's 14 consecutive years up to 2023 now. Yeah, so we even got the same thing for 2023. And we've earned 100 AGM assessment scores for the 6th consecutive year from 2018 to 2023. And we're also a member of the Thailand's Private Sector Collective Action Coalition Against Corruption. So the final food for thought on the industry side, demand is expected to grow over the next couple of years. We have zero business out of Thailand. Therefore, the weaker the Thai baht, the stronger our earnings per share in Thai baht, as all our income is in US dollars. Price to book value is not a good measure anymore, as asset values have fluctuated very sharply, both up and down, since the start of the pandemic. Our debt continues to shrink. Should be good news for shareholders. Demand growth of 3.27% in 2023 is driven by the economic recovery in China, and dry bulk fleet forecast is set to grow by 3.6% in 2023 and 1.8% in 2024, but will be reduced by 2 to 2.5% during these 2 years due to compliance with EEXI and CII. So supply-demand balance should improve in 2024 and rates should react appropriately. And with that, I will hand you over to Gautam.
Thank you. So here are some highlights for the second quarter results. So our net profit for the quarter was 285.87 billion baht, or USD 8.21 million, or 18 satang per share. Our EBITDA was 639.98 billion baht, or USD 18.38 million. We declared a final dividend for the year 2022 of 25 satang. This was paid on the 9th of May 2023. We also declared an interim dividend number 1 of 5 satang. This was paid on the 14th of June. In terms of financing, so on 27th of April this year, we completed the drawdown of a $9 million loan from EO Bank. This is a Japanese bank. We used the loan proceeds to prepay a 4.1 million loan from Sinopac. This is a Taiwanese lender. Also on 20th June of this year, we completed the drawdown of a 15.9 million loan tranche from Bangkok Bank, the Singapore branch. In the second quarter, we fixed 2 more of our ships on long-term contracts at variable rates, that is linked to the underlying index for vessels of that size. So in aggregate, we've got 5 ships on long-term fixed rate charters and 17 ships on long-term charter contracts at a variable rate that is linked to the underlying index. So this variable rate is recalculated every 2 weeks, depending on what the index level is. So revenues for the second quarter this is in US dollars, came in at 39.1 million. This was up from 34.6 million in the first quarter. Our net profit as a result was 8.2 million. Of this, about 0.7 million comprised non-recurring items. Our net profit in the first quarter was 2.3 million. The earnings per share was 18 satang compared to 5 satang in the first quarter. Return on equity was 3.79% compared to 1.34% in the first quarter. Our net debt to equity ratio remained the same at 0.34, and the number of ships in our fleet also remained the same at 38. So this over here, if you look at the top left, this shows you the time charter rate per day per ship on average for our fleet. So this is data, we're looking at data from the first quarter of 2020 until the second quarter of 2023. So you'll see that the rates peaked in Q4 2021, and since then they declined, and then there's been a slight reversal in trend in Q2 2023. Historical EBITDA follows a similar trajectory. Bottom left, we show you the dividends that we've been paying. And bottom right, we show you the cash balance. Our current cash balance stands at 35 million at the end of the second quarter. This over here is our statement of financial position. So the biggest item, of course, is vessels and equipment, which at the end of last year stood at 638 million. And at the end of June, it is 626 million. Our debt has remained fairly stable. It was 476 million at the end of last year, and currently at the end of the second quarter, it was at 472 million. 194 million is the debt, and now 197 million. Shareholders' equity was 476 at the end of last year and 472 at the end of the second quarter. This over here shows you the cash movement. So at the end of the first quarter, our cash position was 25 million. We generated 21 million of cash from operations. We had 5 million of capex, mainly for dry dock related expenses. We had loan drawdowns of 25 million, debt repayments of 8 million, prepayments of 5 million, so comprising the prepayment to Sinopec in Taiwan, plus a small another prepayment for another loan. We had interest payments for the quarter at 3 million. We had dividends of 14 million, and our cash at the end of the quarter was 35 million. This over here, we show you the operating expenses, a breakdown of the operating expenses in Q2 against Q1. So crew costs were slightly down in Q2 compared to Q1, but that's mainly because we had more crew changes in Q1, particularly in the Atlantic Basin, which is a more expensive place to change crew. Other than that, costs have been fairly stable. I would just say going forward, we expect insurance, which has been rising for the last few years. Insurance premiums should stabilize going forward. Yeah. And I think in the last 2 years, we also saw the impact of inflation, but those inflationary pressures are going away. Over here, we show you a comparison of our OPEX with the industry average OPEX. And so you'll see that we are always consistently lower. Our operating costs per ship per day are consistently lower than the average of the industry. Now, every $100 in savings in operating costs translates to about $1 million on the bottom line. The figures for 2022 haven't as yet been published, but we expect that we will continue to be lower than the industry average. Over here, we show you the OPEX and GA expenses of our peers, our listed peers who are also operating Supramax and Ultramax vessels. So we're just looking at data for Supramax and Ultramax vessels. So you'll see that we are, so these are global peers, not just in Asia, this is global peers. And you'll see that as far as OPEX and GA is concerned, we're the second lowest compared to our peers, our listed peers. But if you look at the last 12 months EBITDA per ship, you'll see that we have outperformed all our listed peers. So the figure that we had for the last 12 months, the EBITDA per ship came in at 4.96 million. Our closest peer was at 4.76. And this is fairly consistent. We tend to outperform our peers on this metric. This over here is our debt maturity profile. So it's fairly flat, and I would expect more flattening as we enter into more refinancing contracts, maybe later this year and next year. We will continue to try and extend the maturity of our debt facilities out. This over here shows you our net debt and net debt to equity ratio from 2012 until today. So you'll see that our total net debt sort of peaked in 2007. This is when we took delivery of 17. This is when we took delivery of our last new building vessel. We had a whole series of new buildings that we had ordered and took delivery of in the prior years. And then since then, it has been coming down, and also the net debt to equity ratio has also come down, and it's currently at 0.3. So over here, this shows you the average OPEX TC rates, but first we also show you the average age of our fleet. So you'll see that from the year 2000 until the year about 2013, our fleet was fairly elderly, and it started to decline as we took delivery of a number of younger, larger ships, and the average age came down to 5.8 in 2016. And the ships that we took delivery of or they were also larger. So the average size of ships in our fleet in the year 2000 was 22,000 deadweight. Today it's 43,621. This line, the dark green line below that, it shows you the time charter rate per ship per day. So you'll see that in 2003 to 2009, there was a super cycle as China joined the WTO. There was a big building boom in China, but then there was also a huge order book, as we have seen in around 2008, 2009. The order book stood at about 80% of the existing fleet. And all those ships got delivered from 2008 until about 2016, and they put pressure on rates. Those deliveries stopped, or that, and thereafter you started to see rates gradually move up. And now, as we have seen, the supply pressures, fortunately, are still not there because the order book compared to 2008, 2009, it was at 80%. Today, it's only about 7%. Over here, we show you the OPEX of our fleet, the average OPEX of our fleet, which has remained fairly stable over time. Of course, as I said, so in the last 2-3 years, we've also been impacted by inflationary pressures, and there have been some increases, but those pressures are decreasing. So this over here, we show you the dividends that we've paid from the year 2003 until today. So our policy is to pay not less than 25% of net profit as dividend. But again, as you'll see, we have generally paid more than 25% of net profit as dividend. We reinstated, so there was a gap in our payments of dividends. We didn't pay dividends from 2014 until 2021, but we reinstated the dividends, and we continue to do so. We continue to pay dividends. Of course, the dividend for the second quarter will be decided after our board meeting on Friday. Over here, we show you the data. I'm not going to go through this. This is a reference slide, which you can refer to if you wish. Same thing over here. So over here, we show you the total return to shareholders from 1993 until today. So if you were an investor in our IPO in 1993, and if you held on to our shares until today, you received all the dividends, you would have earned you would have had a compounded return of 15.89% basis the stock price, which was on 27th of July. It's just some data on our investor relations activities. It's been a fairly active last 3 years. And with that, we are open for questions.
Okay, so coming to the questions, the first question is the rate outlook for the second half of 2023. As you know, we don't give forward-looking statements, so I really can't answer you on that one. The next question is, are you going to be buying new ships very soon? As I noticed that new subsidiaries have been formed and intimated to the SET. So there are two questions, one here and one a little later at number 8. So yes, we are preparing to act in an opportunistic manner once market starts to move up again. Similarly, there's a question, when will you plan to sell your old fleets? And the answer is the same. We will opportunistically sell our fleet as the market goes back up. The fourth question is, currently, what factors can affect the index and in the future? So the factors that affect demand or supply will be the factors that will affect the index. So first of all, could be some sort of disruption, like for example, China not buying coal from Australia, then Australian coal was being moved from Australia all the way to Europe. So it was much longer ton miles as compared to Chinese ton miles. In the meantime, China still bought much more coal than they were buying in the years before. And they still got that satisfied from some other places, and therefore ton miles just went up. So that is something that will be interesting. The rest of the world is heading towards recession, as we keep hearing in the Western media. Now, if that doesn't happen, then that will be good news. It'll allow an increase in demand. And if there is further increase in demand, then congestion might go back up. As I've shown you, it's dropped a little bit. If it goes back up just a little bit, it'll be enough to cover the gap between the increase in supply and the increase in demand. And therefore, again, rates should start moving up. So these are the factors that you should be looking at, and also watch whether recycling of older ships keeps going up. Then the next question, which is the fifth question, is about the growth of supply and demand. Then why is the BDI going down in the opposite way? So there are two reasons why the BDI has come down in 2023 in the first half, and that is linked to, on one side, demand coming down in the rest of the world, and the second side is congestion reducing in most parts of the world, therefore releasing more ships. So supply increased compared to last year, and secondly, demand fell because many of the countries in the rest of the world were slowing down. So both these factors came together, and therefore you had a BDI going down, even though China's cargoes have been going. The sixth question is that shipping is a cyclical business. Can you please guide us? What should we be looking for as signals for an uptrend? So first of all, of course, better economic health of the economies in the rest of the world. I think China will continue to do very well. You don't have to worry about China. All you need to worry about is, and watch, is whether the rest of the world starts to grow. And if they do that, then we should do very well. Crops, as you know, are being affected very sharply and strongly by the unusual weather that is there because of climate change. So if you look at China and the grain growing region, which is mainly in the northeastern part of the country, you will find that there was drought during the summer months and very hot, followed by extreme flooding. So now, right now, the largest grain growing province in China is basically inundated with flood waters, and crops are actually underwater, more or less. So we think that China will continue to buy a lot more grain starting in the second half of this year and continuing for 2024. So that is what our expectations are and what you should be looking for in terms of what's going on. In the last question then is that, given the current low share price, do the board of directors consider it an opportune time to add to their shareholding by buying in the market as per some of their shareholders? Surely it is worth it on a long-term outlook. So maybe, Gautam, you want to take this question?
Well, while we don't disagree with you, I think it is difficult to comment on something as specific as this.
But I would add that it's a good time to be buying shares for people who don't have shares. For people who are holding a lot of shares, maybe it's not a time to either sell or to buy, but to just hold. So with that, we've come to an end of the questions through the chat. So if there are any other questions from the floor, we can answer those.
ค่ะส่งคำถามเข้ามาได้นะคะ
Stop this share.
ค่ะดูเหมือนจะไม่มีคำถามจากทางผู้ลงทุนแล้วนะคะวันนี้ทางบริษัทก็ขอบคุณสำหรับการรับชมการรายงานของเราในวันนี้นะคะแล้วพบกันใหม่ไตรมาสหน้าค่ะขอบคุณมากค่ะ
สวัสดีครับ